Welcome to a new episode of the Unicorn Bakery. My name is Fabian, and today we will have a look at Seedcamp's recipe for success. Seedcamp is one of the most renowned pre-seed funds globally and invested in companies like Wise, Revolut, UiPath, Ramp, Pleo, or Hopin, and 450 plus more. So there are a lot of investments done throughout the last 15 plus years. Seedcamp recently raised their sixth fund with, I think, $180 million in volume. And therefore, I'm super happy and grateful to welcome Seedcamp co-founder Reshma Sohoni and associate Kate McGinn. You're also especially interesting because I'm German and you're focused on the German market as well. And we will talk about that in a second. And I'm a bit excited. So Reshma and Kate, welcome to the Unicorn Bakery.
Thank you. Great to be here.
Yeah, thanks for having us.
Reshma, I'll start with you. Seedcamp started as an accelerator and now is a fully fledged pre-seed and seed fund. And I would love to understand about, because in the startup context, we're always talking about pivoting and changing directions. I think I haven't talked to any VC changing or pivoting. How is it to manage the pivot of a fund vehicle and why was it necessary?
Great question. I think kind of going back, when we started, I often say kind of in Europe, it was a bit of a desert, right? America was pretty reactive after the dot-com crash of the early 2000s. They sort of got back up in terms of back to kind of risk-taking investing, but Europe hadn't, and a lot of folks had left the market. And so I think when we came in laser focused on what we wanted to do, which is back a whole lot more European founders, whether they were repeat, whether they were first-time founders, ideally first-time founders, because that's a great way to really enlarge the base of a pyramid. I think it was easier to latch on to a term because it was too generic to just say we're an early stage investor. And I think the model of kind of the early aspects of the model of an accelerator were being embraced, very well. People really understood that term well. We were inspired by kind of what Y Combinator had been starting already a couple of years before, and then Techstars as well, the early proponents of accelerator in the US. And so we were inspired by both. Two very different approaches when you dig in more. And so we sort of felt like that word defined us well, or we identified well with that term. As it turns out, actually, so maybe to answer your question, we didn't pivot. I think as it turns out, we were inspired by some of the aspects of how they were rethinking early stage investing and operating, and then the realities of how we needed to implement that in Europe, very much the market forces not being similar to the US at all. So we implemented our approach to early stage in very different ways. So we didn't have kind of demo days. We didn't have a 3 months and out program. We didn't, we had cohorts, but they were central. They weren't sort of, they weren't disparate, kind of fragmented ecosystems. We were not asking companies to move all of them to move to London, but actually build their ecosystems locally. So we never operated according to a definition of accelerator, which at the time wasn't an accepted definition. I think it became more so maybe into 2010, 11, 12, when we were already 3, 4, 5 years old. And so I think as that definition got more solidified, I think into what Techstars was operating it as, when we looked in the mirror, we weren't operating it in any way similar to that, which is great because we had our own unique way. So we sort of said, this term doesn't really apply, and we should just, now that the ecosystem across European footprint had matured, kind of the understanding of pre-seed, seed investing had matured, we sort of let go of that label because it certainly wasn't helping. I think when founders also are attracted to labels, they associate certain aspects with it. And so the kinds of founders that were attracted to us or vice versa, didn't find that a valuable label, since we weren't operating according to what was accepted definition at the time. So we didn't pivot. We really let go of a label that didn't really match what we were doing.
That's interesting. It always sounds like when you hear it started as an accelerator, like even when an accelerator in itself is often a fund, it sounds like a pivot, and then realizing that back then also just the terminology was not perfectly set yet, so it was not clear what is what, and then also identifying, okay, we were always operating as a fund, but we labeled ourselves as a...
Absolutely. I mean, and we were a bit of a investor collective, always in a fund, but an investor collective, and then even more so. But I think for your audience, which is obviously going to be a lot of founders themselves, a lot of operators, there's always a distinction between what is marketing and what is shortcut marketing and terminology. That's certainly helpful because our brains work that way, that we want shortcuts and terms, and what is as you just said, reality of the day-to-day operating. And when you sometimes look at the term that you're using as a shortcut, and you kind of go, well, that just doesn't.
Fair enough. And I think a lot of founders, startups, VCs should be just more honest to themselves, look in the mirror and realize, okay, we're actually that even when we marketed something else. So therefore, I think that will be super helpful for a lot of people out there in the ecosystem. Kate, I have a question. Honestly, it's not a sixth fund. You're still, as Seedcamp, I would say, quite small team, very, very focused. And I would love to understand what changes with a new fund. Now it's Fund 6. There are a lot of learnings out of the first 5 funds. A lot of things happened, hundreds of investments. What is coming to life with Fund 6?
Yeah, good question. And I think one we always try to recalibrate, quarter on quarter, because we're an always evolving fund. Our partner, Tom, he says it quite well. He says it's an evolution, not a revolution. And I do think that's the case with Seedcamp Fund 6. So yeah, it's just building on all the good work that happened through Seedcamp 1 through 5, taking the best elements and then dropping some of the things that maybe aren't relevant in 2023 anymore. So one of the things that we're increasingly doubling down on is our angel collective. We've increasingly realized that there's just so much value that angels bring to cap tables. There's also a lot of value we gain from angels in potential deal sourcing, just getting advice on different companies and sectors that we perhaps aren't that familiar with. And so that's something that we've definitely put at the center of Fund 6 is just, how do we engage, add value to those angels that are really close to us? How do we expand that pool of angels, right? I mean, you have kind of super angels and these big geos, but they're also, future super angels that we want to be building early relationships with. So it's a matter of doing that, programmatically, but also individually, right? All 6 of us on the investment team thinking through those people, those geos of those angels that we really want to be close to and doubling down for Fund 6. So that's definitely one of the core focus areas. The other core focus area absolutely is Germany. So it's our 3rd biggest geo of investment. So UK is still number 1. That's where we're based. That's our home ground. It'd be awful if we didn't do the UK well. 2nd is France. That grew in recent years a lot. But yeah, we've really developed a strong ecosystem of founders there. And obviously there's ripple-on effects when you have a strong founder community, them referring other founders in that network as well. Germany is our 3rd largest geo, but we definitely wanted to increase our exposure there. And I think there's a ton of things that Germany is really great at. A ton of things that we see make them a really strong ecosystem, right? Like you have the Mittelstand. I think in general, Germany is just such a production-heavy economy. I think it's still like the highest value of sold production happens in Germany. So it's something like 26% of like all of Europe production happens in Germany. As a result, there's just, a ton of companies you can sell to, a ton of software companies that can optimize, those different elements of the economy. There's also a ton of government support that we're really excited about, especially when it comes to climate. We're seeing a lot coming out of climate in Germany. even with like home retrofit, there's a ton of government kind of support with that, energy, supply chain optimization. We're just seeing so many different government supported initiatives that are making it easier for startups to exist in those spaces. So that's another thing that we're looking at super, super closely. And I would say the third thing that we're really excited about with Germany is just the talent that's coming out of there. I mean, the research universities that, aren't just in Berlin, but are in Munich and Karlsruhe, even in small geos like Aachen. We're seeing a ton of really, really cool startups off the back of those universities. And this is the case with all a lot of startup ecosystems, but there's a lot of scale-up talent that now is startup talent, right? Like, as Zalando, all these big companies who are now creating new talent that we can now invest in. I think we're totally seeing in Germany, and that's what's making us very excited about it. So yeah, it's a geo that we want to be focusing on during Fund 6.
I definitely can be number one in the geos, right? So definitely outgrowing the UK in your portfolio. No, I'm joking, but what I would love to understand from the reverting back to the angel collective that you talked about, what is the triangle between Seedcamp, the angels, and the founders? So who is getting what value? Are you sharing deal flow with the angels? Are the angels sharing with you? What are the incentive structures here? What are the incentive structures with the founders to also, of course, money is money. So they're sometimes happy just to fill in their rounds. But at the same point, like, how is that structured? Kate, if you could give me a few sentences, or also Reshma, give me a few sentences on that collective.
Yeah, no, I'll let Kate definitely take that on. I think just to set context as well, it's great in our team. We've again evolved into some of us have been there 15 years ago, some of us who've now been there a couple of years, and we'll certainly be continuing to grow our investment team. Is when you look back 15 years ago, where Kate mentions now a lot of our focus in Fund 6, those folks literally didn't exist 15 years ago in Europe, particularly. For sure, in the US, it's grown. In China, it's grown. In India, with this group of kind of again a broad collective of angels has tech angels has grown. But in particularly in Europe, it didn't exist 15 years ago. So if you don't evolve with the market, you are left as a fossil, right? So Kate will go into that a bit more, as you just asked. But I think to say what we didn't exist now exists, and it's our intentionality around that, because of course over that 15 years, it's grown from angels have grown from like a seed group into a nice scale of angel activity. So it's just we've been bringing more and more intentionality to working with angels. But yeah, it's to say that 15 years ago, wow, I couldn't even kind of put up 10 fingers and figure out which angels to work with. But I'll let Kate talk more.
Yeah, no, I think that's such a good point. Like, angels, I feel like are still a new thing, especially professional angels who are angels full time and invest at a super high cadence, right? I mean, this is still a rare breed in the US. There's many more of those types of people, and they can literally lead pre-seeds, these individual angels. I think more of that is happening in Europe, and we can benefit from a lot of that. But again, it's like almost helping build up those people in some way, right? Because we have a duty in some way to kind of also move forward the venture ecosystem in Europe. What you were talking about with triangulation, I think that's such an interesting way to put it, because yeah, at the end of the day, we kind of like, we're friends and we can just, we have a ton of like social events where we bring together angels and the larger Seedcamp Nation. But at the end of the day, right, like everyone kind of has a reason to be at the table, and deals in many ways the currency that we function on, right? So absolutely, we share deals with angels. We do that actually on a monthly basis. We have this WhatsApp community. We also have a thing called the Angel Forum. That's a way for the angels to actually come together in person on a quarterly basis. A matter of then meeting our founders, having founders pitch to us or pitch to the angels. And also just serving as like a good networking opportunity for them. And then, of course, because we give a lot to those angels, angels also give a lot to us. And it's not necessarily like, we share something with you, so you better share something with us or else. It's more a matter of they really, they rate us and they rate us as investors. And when they meet a great founder, they say, wow, okay, I mean, if we do this with Seedcamp, there's a lot of value to be gained for the founder. And so I do think this is essential, is that the founder is really at the center of the value creation, but also the value adding. And so angels and us are thinking, okay, how can we be helping each other so that at the end, the founder can ultimately, get the value? Because if the founder gets the value from us and builds a massive company, we'll all benefit from that. So that's typically how we do it. And then I think in addition to deal sharing, right, there's a lot more that is part of being part of the Seedcamp Nation, which we kind of see angels as being a part of. It's a matter of serving on in our expert collective, which is a group of mentors who support our companies on functional areas of expertise. A lot of those people are angels. Obviously, our angels are also part of our LP base. There's another way of kind of incentivization there. And yeah, there's just a ton of different ways to kind of get linked into the Seedcamp wider economy. Another thing is talent. A lot of angels who aren't full-time, who perhaps eventually want to work for a Seedcamp portfolio company. And that happens on a super regular basis. Our head of talent, he basically manages a lot of that and kind of, again, connects these different dots. This is the beauty of having such a large ecosystem that Seedcamp's kind of created over the past 15 years. There's always like sub-value to be created within the larger branches. But it's also staying hyper-focused on, okay, how can those individual relationships, yield benefit for someone else, and kind of just always be connecting the dots. And always be top-notch in that, right? Because if you don't leverage your ecosystem, the ecosystem is useless, and it's as if we're not really getting the value that we've been working for the past 15 years.
Fair enough. But such a good point. And what I think with Seedcamp, and I honestly, how I discovered Seedcamp, because I somehow stumbled into the startup ecosystem, therefore then met a few people. They told me about different people to talk to, and one of them was Philip Möhring, Tiny VC, who then also did the introduction to Reshma, and therefore this is happening because of Philip. So thank you. Who I was told back then Tiny was like 2 people, and that was like told former Seedcamp, and I was like, okay, I have to put this all together. Like, how did this start? And that's how I at some point got introduced in 2018 the first time to your strategy, because I think there are not many funds staying true to their strategy for 15 years, but focused on, we're staying quite small. Of course, $180 million fund is a large fund, but still you're more on the side of doing 35 investments a year instead of, for example, some others do 10 to 12 investments a year, more concentrated, larger ticket sizes. So they do 30 deals a fund. You do, for example, around 100-ish deals per fund. You didn't expand the fund size to 300 or 350 million or 400 million, even when I'm quite sure that it would be possible if you would try to push it that far. So Reshma, I'm super interested in how you think about fund strategy and why you chose the strategy that you chose. Because I see a lot of funds doing it differently, and I always try to figure out why are funds acting like they do, because why did they choose the strategy they are using?
Right. So I think, two key elements. One is kind of the entire thing connecting up and adding up into authenticity, and I'll dig into that. And the second is performance and what kind of performance we want. So on the first one and I think why the LPs, that have been with us since Fund 1 when they were VC and Angel LPs, to since Fund 3 and 4, more institutional LPs, it continues to be the same sort of group of folks that have been supporting us and understand our story, understand is a core aspect, which is it all ties together and it's authentic to who we are. So what is that? It's 3 things. One is our team, with the investment team, and of course our platform team and our engine team, which is all the sort of fund management aspects that the engine team works on, is that whole team loves the early stage. So we are obsessive, and we're as obsessive about it 15 years ago, 10 years ago, 5 years ago today, and hopefully the next 5, 10, 15 as well, is that we really, really, really love the early stage. So that's the whole of the team, and we recruit in that team across those three areas, investment team, platform, and engine, for those who breathe that, who act it, live it. So the team. But the team isn't alone. Our modeling, our fund modeling, and kind of the data we have and collecting 15 years of experience has to work alongside the team, a team that loves the early stage and acts accordingly. And our model does that, right? Our model around this sort of 30, 35 investments a year, 100 to 120 company fund per fund, and the return profiles and the kinds of founders we back and the outcomes we're looking for from those 100 companies and the distribution. The model all works to connect with the team who's deploying the model. And then last bit is again kind of team model, and then the action, the operations, and how you tactically execute year after year after year on that. So those three things our LPs deeply understand. The LPs who back us deeply understand. And we think, because those three things tie up so well together, it leads to the second key point I mentioned, which is performance. We absolutely know our job, which is for sure to have massive impact in the world, for sure to give, to build this base of an incredible European sort of pyramid of incredible talent that we back, these 100 companies per fund, and we're part of a larger ecosystem doing that. So, hopefully the team members that leave, we love to support them, Tiny, as you said, and others who've gone on to other places as well. It's a long list, and we love that, right? Is we know that we're all part of the same ecosystem, and it's great to have. But alongside that, we're performance driven. So all those three things are not worth it for us unless we are incredibly high performing. So for us, it is in that top few funds in Europe. So whether you want to define that as top 1%, top 10%, top quarter, whatever it is, we really want to be in the top few names that roll off the tongue on who are the highest performing globally, particularly out of Europe. So yeah, it's the connection across all three and led by performance. We always therefore design our fund to not be too greedy, because we're not sure we can deliver those same multiples and IRRs if we change things too significantly that then depart from the authenticity of who our team is, how it's connected to our model, and then how it's connected to how we can actually operationalize week to week, month to month, year to year. So those, hopefully that gives your audience a good sense of why we tend to stay in the lanes that we love to stay in, because we're extremely, so far, high performing, and it's authentic to who we are. Within that, as you said, we evolve. So our fund size has evolved, grown, is the right word, but it's within the realm of how the markets have grown and what our founders are demanding, and what we can help support.
I would love to quickly ask a follow-on question. One, what dynamics have to be in place that the high performance is given? Because I think a lot of large funds that are raising 300 million, 400 million, 500 million, doing 10 to 15 investments a year, have to have 1, 2, 3, 4 unicorns to somehow work out, which is, if we look at exit value in Europe per year, quite unlikely and hard to achieve, but still I hope all the best for them. And so what dynamics have to be in place that this works out with your strategy? And given that we are coming out of a hype cycle where in 2020, 2021, all the valuations were going crazy, how robust is this investment strategy in such a hype cycle, and how performant is it during such a cycle? Is it good that you distribute over let's say 100 deals throughout the fund because you then have enough balls in the park, or is it sometimes also maybe not as good? I have no clue, but I would love to ask that question to understand a bit better the pros and cons of the investment strategy.
Yeah, no, clearly we believe in burst strategy, and our LPs do too. And the last 15 years showcase that. But I do think your point is valid, that there's also been, within 15 years, there's been certainly a hype or an up market cycle, right? And we're in a down market cycle. So our strong belief is our model and the way we operate and our team deliver to any cycle. Our view is we're helping be part of the creation of companies that last the test of time. So whether if you last the test of time, you're definitely working through two cycles, one being up, one being down for sure, if not longer, because they tend to take 10 years at a time, roughly. So I think given that, the other we're there for companies that have longevity of 2 decades or more, and we're coming in at the very beginning. So you think even with dips, and you're ultimately up and to the right. I would say what to navigate the up and to the right from coming in a pre-seed seed is those timings of the up cycles and those massive dips that we all have felt in the private markets, public markets over the last couple of years, and then get back up out of those cycles again. So our model around 5 to 8% ownership that we have in our companies means we're working on a portfolio company approach. And so we will have more companies able to be there in 20 years versus a very few small, bets on goal as such, right? In a market, it can be attractive to want to break that, because it'd be very nice to own 20% of a $30 billion business versus 5%. So I think the math alone there, it's very simple and clear. But again, that only works when you're working in narrow timelines of a perfectly timed, if you can tell if you're a fortune teller and can tell that time is. We can't, and therefore our model on being able to be catering to a group of companies that have that same long-term vision, that want to build businesses that are high impact, extremely high impact for 8 billion people on the planet in, obviously many different vectors. I think those are all those aspects make sense for, again, our model to be able to have access to a percentage of those companies that are going to be standing that test of time.
Interesting. Thanks for sharing, Kate. Coming back to Germany a bit, because of course Seedcamp is a household name. It's not that you start a completely new fund and then have to figure out how to approach and building a fund at all, but you still have to leverage what Seedcamp has and bring it to a new country more sophisticated, more focused. So who are the first people that you're talking to figure out the baseline for setting up everything that Germany as a country can get more significance for the fund? I ask that because I think that's interesting for other funds to figure out, okay, who are the people talking to might be interesting, but also for a lot of people who are thinking about establishing a brand in a different country and then think about, okay, what is the abstract of, for example, multipliers, etc. But so who are you talking to, and how are you assessing Germany in general to make to turn on the switch of, hey, we're fully here?
Yeah, good question. I think you make a good point that it's definitely not as if like the switch was off and now it's on, right? Like we have been in Germany for a long time. Is invested in companies like Grover, WeFox, who have, in part shaped a large part of the German ecosystem as well. So yeah, it's definitely not started from ground zero. It's just like having a more keen eye on the ecosystem, especially with regards to, okay, which sector and which geo is more interesting because, right, as compared to a France or even a UK, it's a lot more distributed. There's many more hubs of interest, and a lot of those hubs are more correlated to certain sectors, like, manufacturing or climate, as I said, or B2B SaaS being greater in, for example, Munich. So it's just having a keener eye on those types of things. Now, who are we speaking to? I mean, obviously, we do have a founder community there, right? We have a founder community in Munich. We have a strong one in Berlin. That's actually, a lot of newer companies. We've invested in a couple companies, for example, in the dev tool space, one being Current AI, which we announced at the beginning of the year, and also Crowd.dev. With Crowd.dev, for example, we hosted this open source kind of community drinks, right? It's getting back to those founders and trying to speak to a larger audience, but through those founders who already have kind of embedded ecosystems in, their different geos. So that's definitely one way that we're getting closer to people that perhaps didn't know us as prevalently, or who perhaps, we didn't really know as prevalently. So it's definitely our core founders. Second, right, as I said, angels are a huge focus area for us, and definitely it's the case in Germany as well. And you have a ton of angels in Germany who are very prolific, especially like in Munich, Berlin, even in like Karlsruhe. I think those are the three ecosystems that are pretty big at this point. We are trying to tap into that angel community, having them be part of our larger angel collective, right? That quarterly cycle that I was talking to you about bringing angels together and having them meet our founders and having them meet other angels. So it's a matter of chatting to those people. And then it's also a matter of looking at our founders and the angels that backed our founders and kind of almost having a list of, okay, well, it seems like, these 30 angels we've already had touch points with, we're already connected to via our founders. Now it's just a matter of actually more proactively reaching out to them and saying, hey, we've been on two cap tables together. What else can we do? So that's the other one. And I would say the third, I mean, obviously there's a ton of funds in Germany. There's a ton of venture money. We're obviously in close contact with all of those as well. But it's also some of these newer funds, like Fabian, I don't know if you know, First Momentum, like they're, like a kind of a newer, grew out of a university, and they're a really proper fund at this point. Those types of funds we're super keen on getting closer to, and so we're building relationships with some of these newer funds, these micro funds, that perhaps are kind of building up their reputation, and could be potentially good partners in very specific geos. So that's the other thing that we're proactively doing.
How do you approach such, for example, fund relationships? Because I'm media, so therefore somehow I have to think about things differently or with caution, and I'm looking at brands sometimes. Who do I invite? But that's not what I mean. But it's more the question of how do you assess who to work with? Because at the same point, you somehow often work with everybody who works in the constellation for the founder. So how do you assess who do you actually are approaching, and who is naturally at some point maybe in the same cap table? So how are you assessing these newer funds, for example?
That's a good question. It's probably more case by case, right? Like you'll always know people who then know that fund and maybe potentially give some more insight as to, what they're even interested in. Are they exclusively hardware, which is something that we don't really do? Are they more software? If software, then, what kinds of things are they interested in? So, it is obviously kind of just like knowing your nodes of influence almost, kind of, sussing out the quality of a fund that way. I would say it's also just talking to that fund. I think, our whole job is sniffing out good companies and like having a keen sense for what's greatness. And I think the same holds true for funds, right? Like, speaking to a fund, spotting whether they, you really feel like they could add value to a founder. And if that criteria almost has been met, if we have confidence that, okay, wow, this fund is going to add value to a founder, then that fund's, there's a chance that fund's going to perform really well, and it's a fund we should stay close to. So I think it's pretty simple. It's kind of what we do, right, with companies, and we try to apply that lens almost to funds themselves.
That makes sense. Reshma, how much can you reverse engineer from working with Wise, Revolut, UiPath, and other great companies, who to look for today? How much is reverse engineering helpful, and how much is it maybe also, false information, because it's not as simple as just looking at what worked for others when you are looking for new companies and new founders to work with?
Great question. I hopefully, I think when we are looking, back at their journeys and then therefore applying some of those patterns going forward, I think the excellence versus the poverty of making those judgment calls is on what you look at. So I think, as with starting with Seedcamp, not to replicate what we saw elsewhere, but to be inspired by what we saw elsewhere, and looking at what are the elements that would make our journey as building Seedcamp a good fit for that inspiration. So same thing, if you look at kind of Wise's trajectory, and as any startup will tell you, whether it's Wise or Path or Revolut, like there are multiple times you almost die, or you definitely have those kind of crap where product doesn't work, or we're running out of runway, or we made some bad talent decisions. Like there's multiple ways you could die, yet they don't, and they become companies that build a 1 million, a 10 million, 100 million, $1 billion revenue business, right? And so I think for us, it's making sure, and again, it's easier said than done, is understanding what are the triggers, or what are the reasons that led to their success, what are the kind of plotting points along those journeys, and then transposing them into today and going forward of what are the different aspects of the companies being built today, the founders being founders doing that today versus who the Wise founders were or the Path founders were. Revolut just celebrates their 8th year anniversary. When you think of that, it's like kind of mind-boggling, right? They're already 8 years old. So is to see the nuances of what's different today, what's with the founders themselves, the markets, the ability, like the tangential tech innovation that allows you to distribute customers, users, customers, what's similar, what's different. And to me, it's both simple and extremely difficult to say what's the same and what's different, and what are the likely hurdles along the way, or the likely elements that kind of help with exponential, growth and success. But therein, I think, lies hopefully what we're continuing to be great at, and not getting too hung up on the successes of the past.
Why I'm asking is because a lot of VCs that are sometimes VCs by CV and just became VC out of university, for example, or also whoever turns VC, even when I'm thinking about investments, a lot of people try to find boxes to tick. And I'm not sure if that's always the right way. So, of course, some boxes, like, for example, market, or you should believe in the team, so there are some things that you're looking for. But at the same time, I think often also with content that I'm producing here, people are figuring out, okay, what can I do to look appealing to a VC, but also to build my company, to whatever. Everybody's trying to find boxes that they can tick, instead of sometimes also just fall out of the boxes and try different things. And I'm not 1,000% sure that's more for the VCs approaching new deals right now, how much it's just by, this person became successful because of X. That's why we will invest in somebody who has these traits or has this or that. And I always try to challenge the status quo.
Yep. And maybe, Kate, you can chat a little bit about our own scoring system as such, and how it's evolved, right? And because it is a balance of, when you're making 30 investments a year, that's one every 10 days. You need some level of quantification to how you make judgment calls. And then you need, the qualitative aspects as well. But yeah, Kate's been a big part of, again, continuing to evolve, what we used to do 15 years ago to again, what's better to do in 2023.
Yeah, no, I mean, I think, as Reshma said, right, you have to be, in a way, quantitative, but really that for us is only a mechanism to spur on a conversation that we then have about a company. So after a company goes through an IC with us, we have this scoring system. It's basically a list of questions. It's not necessarily, it's categorized by like team, product, and market. But there are more nuanced questions within those different categories. If there's like co-founders, how do the co-founders gel? How are they compatible? What's the risk of a potential fallout? That would be one question, for example. So they are core to kind of a business. But again, it's a quantitative score that then leads to our discussion post the IC. And so we take those scores to our discussion, and then as a result have a kind of as fruitful of a conversation as possible. If you're going through kind of 3 ICs per week, you just have to do that in a way. But a lot of times, companies that don't score very well are still must-dos in our metric, and so then we ended up doing them as well. And so I absolutely agree with you, Fabian, that there are kind of like, tick boxes of like, is the founding team complete? Like basic things. Is the market big? How advanced is the product? But at the end of the day, you can have a lot of questions, and then there's still one thing that really convinces you that this is just something you cannot miss. And the beauty of our model, as Reshma said, is that we do have a lot of opportunities to invest throughout the year. And so as a result, we can be, risky in our decision-making process. So if there's one thing we absolutely love and we would just, kick ourselves a year down the line if we didn't make that investment, then we'll make it. And that's kind of the beauty of our model, is that, we can make 30 investments a year. It's not just 5 investments that we make where, we have to be 9 out of 10 on all these different questions. That's kind of the beauty of it.
Kate, could you take me through a typical process? Let's say you get the deck from an angel, for example, because we talked about it. You see the deck. How many meetings are we having until, for example, the further due diligence starts, or as much as possible in a pre-seed? So therefore, let's quickly run through the process so that founders understand what's happening after you saw the deck and think, oh, that's interesting.
Yeah, absolutely. So one of our core principles is that we hate wasting a founder's time. Like, you're a pre-seed company. There's a million things you have to do. Fundraising is definitely one of them. But we're not the type of fund to kind of take you through 7 stages, have 5 different customer reference calls just for at the end then to be, a yes or a no. So when we get a deck, let's say I get a deck on, a Tuesday, we'll set up a call in the coming days. And that'll be a first call with 1 or 2 members of the investment team. And on a Friday, we have an opportunity to kind of present some of the top companies that we spoke to that week. And so, that Tuesday's company could be on that agenda. And basically, we just, run through it as a team. We discuss, what's potentially interesting. And then the most interesting companies, the ones we have highest conviction on, we'll bring for an IC on Monday. So the turnover is really quick. On Friday, we decide. On Monday, we bring them in. And basically Friday afternoon, Monday morning is memo writing time, and over the weekends, of course. And then on Monday, we'll have that IC. It's a 45-minute call with the full investment team. Monday evening, we will kind of do that scoring system as I discussed. And then Tuesday, we will debrief with the full investment team. After that, sometimes we'll need some more information. And so maybe that's kind of an email correspondence with the founder. Maybe that is chatting to someone who knows a sector really well in our portfolio. Maybe that's doing a founder reference, things like that. But after that IC, we should have kind of most of the information present to us to be able to make an investment decision. And so over the coming days or a week, we'll basically make a decision.
That's quick.
Sorry. A fun little way of how we think about it. Maybe the women in your audience who've had kids, or the men who've helped having kids, is if you go to the UK health system, and it's very different to the US health system, is because the UK health system clearly doesn't have a lot of money to help you really see doctors through the whole process of the 9 months and then having a child. Really, they say, if you go middle of the road, is you should not need to see a doctor. And only when it's an aberration, and that's fine because that happens, of course, it's real life, is the doctor comes in, right? And then we've got to take different steps into your journey, giving the first several months and then finally kind of the day of, right? And so if you look at our process as well, which Kate just described, we've got the same win-win, like with the national health system as well in the UK. It's like the doctors don't want to see you, you don't want to see the doctors ultimately when giving birth. So you can't say, wait, like we want to invest in you very fast, and you want us to decide very fast as well, right? So that's what we optimize towards is the hell yeah, we want to back you as founders, and the founders going, hell yeah, we want you to be backing us. Of course, in that process where we get stuck on certain questions or certain things we're trying to get to the hell yeah, we'll definitely be very active in trying to address these questions. And sometimes it'll take longer than that process, but we come from an intention, and it matters the intention you come from. And the intention we come from is optimizing around a quicker win-win and towards really big outcomes versus, optimizing for risk aversion and being very worried if a company does not, will not be successful, because actually, obviously, we know majority of our companies will not be successful in the sense of venture capital, right? And so yeah, there you go, a fun little way that gives me a unique perspective, having had a child, 2 children in NHS in the UK, where it's like, I was fortunate enough not to see a doctor through those 2. So, unique perspective on our problem, birthing our investments as well.
Yeah, fair enough. Just to put it in perspective for a few founders, when I looked at into Cherry Ventures, for example, it took sometimes 1, 2, or 3 meetings before we took it into deal meeting. Then we discussed it there, and from that point on, we then did a bit more due diligence, even in pre-seed or seed. So it took a bit longer. Of course, it's a different investment strategy as well. They're doing like 12 to 15 deals a year, so they weigh a bit more in the actual decision, bigger chunks of money, bigger tickets, lead investments so therefore, please put it into perspective. But it's just to help founders navigate what's happening when I'm in that movement, and to figure out the process helps you understanding who you're dealing with and how the process might look like. Because for a lot of founders, it's super hard to see through what process will happen when I talk to a VC, and depending on the VC, depending on the strategy, you will have different processes. So the Seedcamp process might not work with any other VC that you're talking to.
Exactly right, which goes back to everything we start. If your audience was listening to the whole of this session, it goes back to what we talked about, which is our team, our process, our model, our day-to-day, and how does that all connect up? Is that authentic? Does it make sense?
Kate, Reshma, it's been an absolute pleasure talking to you. I really love that you're now focusing more on Germany as well. Super happy to talk about potential collaborations here. I already have some ideas. I'll let you know after I press stop. But I think it's amazing to see that you managed to build the fund throughout the last 15 plus years, 400 plus investments, and what turned out is incredible. Super huge respect for what you've built, and looking forward to see how it's turning out in the next years, because I think, as you mentioned before we started recording, a lot of people that you met throughout the first years are now building new stuff. So it's just getting started. Now the second wave is coming, and a lot of the ecosystem grew so much. So super happy to see what's happening. I'm super grateful that you both took the time to jump on this session, and I would love to hand over to both of you for the last words of this podcast. I can just say thank you. Thanks for sharing everything, and happy to hand over the last words.
Kate, and then I'll say something.
No, Fabian, thank you so much for inviting us on this podcast. I think media is such an important part of an ecosystem's growth, right? And so I think what you're doing in educating everyone and kind of just bringing VCs closer to founders and angels and things like that, I think it's just so critical. So yeah, it's very cool to be part of it.
I'll echo that. And I think just to say, it's amazing to see this ecosystem grow. So much of it in in Berlin and Munich and Germany overall, and it's just really fun to celebrate the successes of our friends. That we're just really thrilled that they're happy and successful as well. In addition to obviously the founders also. So thank you so much for such a thoughtful discussion.
Thank you, and I'll definitely link to Seedcamp and both of your LinkedIn profiles in the show notes, just for every founder wondering. Thank you.